Hello and welcome to FX Street Currency in Play. I'm Matt Brown, coming to you from the heart of London. I'm joined today by Mark Oswald, who is a strategist at ADM Investor Securities, International Securities, Services, apologies. Anyway, Mark, how are you today?
I'm very well, thank you. Very well, yes.
Good. Well, certainly the equity markets, the bears are having their day today and yesterday.
Small.
Small, indeed, very small. And I think the market headlines have probably got a bit carried away, certainly in the equity space.
Well, yeah, when one looks at, there was a 16-day run where the S&P 500 basically closed somewhere between 2770 and 2780. So you suddenly get a big move, even if it's in the grander scheme of things, not particularly dramatic, and everyone gets rather overexcited, particularly given all the North Korea tensions that we've got at the moment. Yeah.
Certainly in the bull run, we've been here before, and we've seen 1% kind of.
Yes, exactly. There's nothing to say that the dip buyers in credit, dip buyers in equities, and the volatility sellers are not going to reassert their authority over this month, this market. Certainly, one knows that there's been actually quite a lot of cash put on the sidelines in equities, so it will be an opportunity. The question is, will the dip buyers think, well, actually, I might need something more this time, and that's going to be the most telling factor.
Well, let's have a look at the currencies in play, and the themes continue. First off, we've got euro dollar in the upper end of the range, 117.30.70. We're looking at US CPI, obviously, later on today, and we'll come on to that in a little bit. Dollar index as well above 93. Cable, slightly neutral, below the 130 handle here. Now, is the pound a safe haven currency anymore, do you think?
No, definitely not. It's the Swiss franc and the yen, and one has to recognise in that sort of relative strength of sterling versus the dollar is it's about dollar weakness rather than sterling strength. I think the more interesting aspect on that really is dollar yen, in the sense that, yes, it is a safe haven, but this is also a function of the fact that when you look at the commitment of traders data from the CFTC, there is an absolutely colossal short in the yen. And again, this is where the market starts tripping up on itself because they've got this big short and everyone's sort of looking at it and thinking, well, the Japanese economy is not doing much. It's going to be years before the Bank of Japan's in a position to raise interest rates while everyone else is starting to sort of sound less accommodative, I think is the right way of putting it. So I should be short of yen, but eventually that becomes an overcrowded position, and this is the result.
It's a bit of a bear squeeze. Right, CPI is the key focus.
Absolutely.
And that's the one the traders should be looking at. So you've kindly brought along a couple of slides really just to explain the CPI and how we may see the number come in today, and certainly looking back at yesterday's PPI number as well. So if you can just walk us through the couple of slides you've got.
Well, first of all, to go through the PPI data yesterday was a lot weaker than people were expecting, minus 0.1, both headline and ex-food and energy. A lot of that was due to energy prices, which fell 0.3% on the month, and also the more volatile trade services. But that's not particularly relevant trade services for the consumer price data. What is relevant is there'll be a few people looking at the energy price move and thinking, well, that probably means that the consumer price data is going to come in below the expectation of plus 0.2%, both headline and core, 1.8 on the headline year on year and 1.7 unchanged on the core. However, there are other factors at work on this. First of all, this idea that the ex-food and energy measure of CPI is actually an ex-energy measure is a bit of mythology, because in there is airfares, and airfares are largely a function of jet fuel prices, and they're pretty closely correlated. So,
surprise.
Yep. So we've had a steady downfall since April in airfares, but over the last month they've been in jet fuel prices, but over the last month they've been steadily rising. Over the past 3 months, the airfares component of CPI is down 5.9% for the whole quarter. Right. So it's that is overdue a correction, and that would also fit with what we can see there from jet fuel prices, which should have had an upward impact on the airfares component. And then, of course, the second component on this, again related to energy, is as much as wholesale energy prices fell on the month, actually retail gasoline prices, which is the next chart I've got with me, have, after again falling steadily all the way from the beginning of roughly the middle of April through to the end of June, have been steadily rising. So that's gasoline is obviously the key weight in the energy price component of that. So that's going to be pushing up on energy prices. So the 0.2% actually does look very reasonable, particularly when one looks at in the context of the fact that housing is relentlessly going higher, generally about 0.2% to 0.3% a month. The question then is that a couple of wild cards are these transitory elements, which the Fed's been talking about. And some of them have already been rebounding. Prescription drugs, which really pulled down heavily in relation to the Healthcare Act assumptions, which didn't actually materialise, did rebound last month. They could rebound quite a little bit more. Wi-Fi services, or internet services as we'd call them, they've also been falling quite steadily due to competition. That may still occur, but I think there's a race to the bottom in that area, and at some stage there's probably going to need to be a bit of a correction. Certainly it won't be as much of a drag, and the moment that something stops being a drag, then the other things which are at work will actually start to push things higher. Now, context obviously needed. We're still going to be below 2%, but the contrast here is markets have been basically looking at all the negative economic surprises in the US. And obviously we had the payrolls data last Friday, which was a very positive one. The average earnings were good. And the CPI, could easily come in slightly above expectations. It's not a big problem for the Fed, but it does mean that things are going their way. And markets, which are priced, particularly for the dollar, which are priced basically for, well, the Fed's going to have to push back on its rate trajectory, and all things are not good in the States, are probably going to starting to get vulnerable to the positive economic surprises. We've had quite a few of them. We also had the JOLTS job data this week.
So if we see a beat on the CPI for the dollar, what does this mean?
Should basically be supportive and encourage some more short covering. Obviously, with the Korea situation, there will be people who won't be going over it, but at the very least, it will encourage some short covering, which will be supportive for the dollar index.
Okay, so we'll look out for that. And on the calendar, obviously the headline there at 1:30, the CPI number, but also Kashkari and Kaplan speaking today. How do you think that could move the market?
Well,
push me, pull you effect.
It's very much push me, pull you. Kashkari has taken over as the arch uber dove on the FOMC. He dissented back in June. And he's likely to sound dovish and sound dubious about the Fed's inflation forecast and its rate trajectory. Interesting aspect, and we saw this from Bullard in the week, is it'll be interesting to see what he says on balance sheet reduction, because it's notable that the doves, as much as they don't see as high a rate trajectory, they do want the Fed to get on with balance sheet reduction. That's important. Mr. Kaplan, I would have thought, will probably stick to the script that we saw from the mainstream of the Fed, which is basically, we've got a plan. There's nothing at the moment which suggests to us that this is more than a transitory drop in inflation. And it's interesting to note in that context, the comments that we had from Mr. Dudley yesterday, that when they say transitory, they don't mean a couple of months. He actually basically hinted quite strongly it could take some time to unwind, but that doesn't affect our rate outlook. So, there is an interesting line here, and there's going to be an ongoing battle between the Fed and markets. I think the important thing, obviously, to remember is the Fed's not going to be particularly worried that the market's assigning such a low probability to a December move, because they know from the experience in February, March, that they can talk the market round. If they want to raise rates in December, come the end of November, expect them to be all on the rostrum and saying, we're going to be raising rates, and the market will turn around.
Understood. So, yep, 3 things to look out for there. We'll skip the Baker Hughes, but Mark, Oswald, thank you very much for joining us today.